Why are there not more people talking about safer investments than cash? Cash might seem like the safest bet, but in reality, it can lose value over time due to inflation. While it's important to have some cash on hand for emergencies, relying solely on cash for your financial security can be risky. So, what are the alternatives? Let's dive into the top 6 assets that are safer than cash and can help you build a more secure financial future. Let's uncover the top 6 assets for your financial security. First up, Treasury bonds. These are government-backed securities that are considered one of the safest investments. When you buy a Treasury bond, you are essentially lending money to the government, which in return pays you interest over a specified period. The risk of default is extremely low, making Treasury bonds a reliable option for preserving your capital. These government-backed beauties offer stable returns with minimal risk. Next, high-yield savings accounts. Unlike regular savings accounts, high-yield savings accounts offer a much higher interest rate, allowing your money to grow faster. They are also FDIC insured, which means your money is protected up to a certain limit. This makes them a great option for those who want to keep their money liquid while still earning a decent return. Think of them as your regular savings account on steroids. The interest rates can be significantly higher, sometimes even 20 times more than a traditional savings account. This means your money works harder for you, growing steadily over time, without taking on much risk. Plus, you can access your funds whenever you need them, making it a flexible and secure option. Then there are certificates of deposit, or CDs. These are time deposits offered by banks and credit unions that pay a fixed interest rate for a specified term. When you invest in a CD, you agree to leave your money in the account for a set period, ranging from a few months to several years. In return, the bank pays you a higher interest rate than a regular savings account. Lock your money in for a fixed period and watch it grow steadily. The longer the term, the higher the interest rate you'll typically receive. CDs are a great option for those who don't need immediate access to their funds and want a guaranteed return on their investment. Just be aware that there may be penalties for early withdrawal, so it's important to choose a term that aligns with your financial goals. Don't forget about mutual funds. These are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. By investing in a mutual fund, you can gain exposure to a wide range of assets without having to buy each one individually. This diversification helps to spread risk and can lead to more stable returns over time. They spread your money across various stocks and bonds, reducing risk. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. This means you benefit from their expertise and experience, potentially leading to better returns than you might achieve on your own. There are many types of mutual funds to choose from, including those that focus on specific sectors, regions, or investment strategies, so you can find one that aligns with your financial goals and risk tolerance. For those who love real estate, REITs, or real estate investment trusts, can be a great choice. REITs are companies that own, operate, or finance income-producing real estate. By investing in a REIT, you can gain exposure to the real estate market without having to buy, manage, or finance properties yourself. This makes REITs a convenient and accessible way to invest in real estate. They let you invest in property without the hassle of being a landlord. REITs typically pay out most of their income as dividends, providing a steady stream of income for investors. Additionally, because REITs are traded on major stock exchanges, they offer liquidity that direct real estate investments do not. This means you can buy and sell shares of a REIT relatively easily, making it a flexible option for diversifying your investment portfolio. Finally, consider corporate bonds. These are debt securities issued by companies to raise capital. When you buy a corporate bond, you are lending money to the company in exchange for periodic interest payments and the return of the bond's face value at maturity. Corporate bonds typically offer higher interest rates than government bonds, reflecting the higher risk associated with lending to companies. Lending money to companies can earn you higher interest compared to government bonds. However, it's important to research the issuing company's financial health and credit rating before investing, as the risk of default is higher than with government bonds. Diversifying your bond investments across different companies and industries can help mitigate this risk and provide a more stable return. There you have it. 6 safer ways to grow your cash and boost your financial security. By diversifying your investments across these different asset classes, you can reduce risk and increase your chances of achieving your financial goals. Remember, the key to successful investing is to stay informed and make decisions that align with your risk tolerance and long-term objectives. Subscribe for more savvy financial tips and stay ahead in your financial journey.